Welcome back to Orange US Stock Research. Today we are diving into Alphabet, the parent company of Google, ticker GOOGL. As of early March 2026, Alphabet trades at about $307 per share with a market cap of $3.7 trillion, $1 of the three most valuable companies on Earth alongside Apple and Microsoft. The trailing PE is 28.4 and forward PE is 25.2. In 2025, Alphabet crossed $400 billion in annual revenue for the first time while generating an extraordinary $132 billion in net income. But with AI investments surging, CapEx projected to exceed $180 billion in 2026, and intensifying antitrust battles from regulators worldwide, is GOOGL still a buy, or are the best days behind it? We will break down the financials, moats, catalysts, risks, and give you our comprehensive score and investment verdict. Let us get started. Alphabet is far more than a search engine. It is a vast digital ecosystem touching billions of lives daily, employing over 190,000 people across 50 countries. Founded in 1998 by Larry Page and Sergey Brin at Stanford, Google became one of history's most influential companies. The Alphabet holding structure was created in 2015 to separate core operations from experimental ventures. The company operates in three segments. Google Services is the crown jewel, including Search, YouTube as the world's largest video platform, Android powering over 3 billion devices, Chrome with 65% browser share, Gmail with 1.8 billion users, Maps, and Pixel hardware. Google Cloud provides enterprise infrastructure, data analytics, and AI services. Other bets includes Waymo autonomous driving and DeepMind AI research. With 80% global search share and 8.5 billion daily searches, Alphabet remains the undisputed king of the internet. How does Alphabet make money? In Q4 2025, total revenue was $113.8 billion, up 12% year-over-year. Google Search contributes 55.4% at roughly $63 billion quarterly, more than most Fortune 500 companies earn in an entire year. Google Cloud now accounts for 15.5%, up from just 10% 2 years ago, a critical part of the diversification story. Subscriptions and platforms contribute 11.9%, driven by 325 million paid subscribers across Google One, YouTube Premium, and YouTube TV. YouTube ads bring in 10% at $11.4 billion quarterly. Google Network accounts for 6.9%, and other bets just 0.3%. The key takeaway is the revenue mix shift. Search dropped from over 60% to 55%, while cloud and subscriptions grow rapidly, reducing dependence on search advertising alone. The financial trajectory is spectacular. Full year 2025 revenue hit a record $402.8 billion, up 15.1% from $350 billion in 2024. Alphabet added $52 billion in new revenue in a single year, more than Netflix's entire annual revenue. From 2022 to 2025, revenue compounded at 12.5% annually. But the real story is the bottom line. Net income surged to $132.2 billion, a massive 32% year-over-year increase, compounding at 30.1% annually over 3 years, far outpacing revenue growth. In Q4, Google Cloud was the standout performer, surging 47.8% year-over-year. Google Search remained resilient despite AI disruption fears. This profit acceleration reflects the immense operating leverage and cost management strategies that permanently improved Alphabet's cost structure over the past 2 years. Profit margins are truly exceptional and stand out even among big tech peers. Gross margin improved from 55.4% in 2022 to nearly 60% in 2025, reflecting better cost management and higher margin revenue streams. Operating margin reached 32%, up from 26.5% 3 years ago, a remarkable 5.5 percentage point expansion. Google Cloud drove much of this, shifting from operating losses to $5.3 billion in Q4 operating income alone, with a 30% operating margin. Net margin sits at a healthy 32.8%. For comparison, Microsoft is at 35.4%, Meta 35.6%, Amazon just 8.1%, and Apple 25.3%. Alphabet is firmly in the top tier and still expanding. Every dollar of revenue produces 33 cents of pure profit at a scale of over $400 billion annually. The balance sheet is a financial fortress. Alphabet holds $127 billion in cash and securities against $46.5 billion in debt, yielding over $80 billion in net cash, larger than the market cap of most S&P 500 companies. Debt to equity is a negligible 0.14. Free cash flow reached $73.3 billion in 2025 with an 18.2% free cash flow margin. The company has become increasingly shareholder-friendly. In 2025, Alphabet repurchased $62 billion in shares, significantly boosting earnings per share. They also initiated their first-ever quarterly dividend in 2024 at 20 cents per share, later raised to 25 cents. While the yield is modest at 0.3%, it signals confidence in sustained cash generation. This financial flexibility funds AI research, buybacks, dividends, and provides a massive buffer against economic downturns. Alphabet has some of the widest economic moats in the business world, and they have only strengthened over time. First, network effects. YouTube's creator audience flywheel is nearly impossible to break. More creators attract more viewers, and more viewers attract more creators. Android connects 3 billion users with millions of developers. Google Search benefits from a data flywheel that has been compounding for 25 years. More users generate more data, which improves the algorithm, which attracts even more users. Second, intangible assets. Google is literally a verb in multiple languages. Their algorithms, 2 decades of proprietary data, and AI models like Gemini cannot be replicated. They hold over 30,000 active patents globally. Third, cost advantage. Massive scale spreads fixed costs of data centers and AI research across billions of users, achieving unit economics that no competitor can match. The biggest growth catalyst is artificial intelligence, and Alphabet is arguably better positioned than any other company to capitalize on it. Generative AI product revenue grew over 400% year-over-year in Q4 2025. AI overviews in Google Search are driving higher engagement and more commercial queries, actually strengthening ad monetization rather than cannibalizing it as skeptics feared. For advertisers, Performance Max automates ad creation and optimization using AI. For developers, Gemini Code Assist serves over 1 million users. For consumers, the Gemini app is becoming a daily productivity assistant. Alphabet's full-stack AI approach is the key differentiator. They build everything in-house, from 7th-generation tensor processing units called Trillium to foundational models to frameworks like JAX. This vertical integration provides cost and performance advantages over competitors relying on third-party hardware. Beyond search, Google Cloud and YouTube are 2 massive growth engines transforming Alphabet's revenue profile. Cloud surged 47.8% year-over-year in Q4 2025, reaching a $70 billion annual run rate, nearly tripling from $26 billion in 2022. The committed contract backlog stands at $240 billion. 75% of cloud customers now actively use Alphabet's AI products, up from under 50% a year ago. Cloud operating margin has expanded to approximately 30%, proving it can be both fast-growing and highly profitable. YouTube generates over $60 billion annually across ads and subscriptions. YouTube Shorts averages 200 billion daily views, defending share against TikTok while improving monetization. YouTube TV and Premium have 325 million paid subscribers, creating substantial recurring revenue. The biggest risk is regulatory and antitrust scrutiny on a global scale. The DOJ filed multiple lawsuits, and in August 2024, a federal judge ruled Google maintained an illegal search monopoly through exclusive default agreements. The remedies phase is underway, with potential outcomes ranging from behavioral changes to forced divestitures of the AdTech network or Chrome browser. European Commission fines already exceed $8 billion. While a full breakup would take years of litigation, and the sum of parts might exceed the whole, these battles create significant investor uncertainty. They could force changes to the estimated $20 billion annual Apple search deal and distract management from executing on critical AI and cloud priorities. The second major risk is surging capital expenditures and fierce AI competition. Alphabet spent $91 billion on CapEx in 2025, nearly doubling the $53 billion in 2024. Management guides $175 to $185 billion for 2026 alone, more than the annual revenue of most Fortune 500 companies spent on infrastructure in a single year. While necessary for AI data centers and custom chip capacity, this will pressure near-term free cash flow significantly. The competitive landscape is brutal. OpenAI backed by Microsoft, Meta's open-source Llama models, and Amazon's AI services are all competing aggressively. There is a legitimate fear that conversational AI could eventually disrupt traditional search behavior, undermining Alphabet's core advertising business if users shift to AI chatbots. On valuation, Alphabet trades at a trailing PE of 28.4 and forward PE of 25.2. The PEG ratio is approximately 2. Compared to big tech peers, Microsoft trades at a forward PE of 32.1, Amazon 35.8, Apple 30.2, and Meta 24.5. Given Alphabet's 15% revenue growth, 80% search market share, 32.8% net margins, and $73 billion in annual free cash flow, a forward PE of 25 seems very reasonable for one of the highest quality businesses on the planet. Wall Street analysts project EPS growth of 12.7% annually through 2028. A DCF analysis using conservative assumptions suggests fair value of $290 to $340 per share, indicating the stock is reasonably valued with meaningful upside potential if AI investments deliver. Time for our comprehensive score. Fundamentals and financials, 95 out of 100. Fortress balance sheet with $80 billion net cash, $73 billion free cash flow, and expanding margins. One of the strongest financial profiles of any company in the world. Economic moat, 95 out of 100. Incredibly sticky ecosystem with network effects across YouTube, Android, and search, unmatched brand power, and massive cost advantages. Growth potential, 85 out of 100. Explosive cloud growth at a $70 billion run rate and AI revenue growing 400% year-over-year. But the law of large numbers makes hypergrowth harder at $400 billion in revenue. Risk profile, 70 out of 100. Intense antitrust scrutiny and massive capex uncertainty. Valuation, 80 out of 100. Fairly valued at a discount to most big tech peers. Total score, a very strong 85 out of 100. Based on our thorough analysis, our investment verdict on Alphabet is bullish. First, cash generation is unmatched at $73 billion free cash flow with $80 billion net cash on the balance sheet. Second, AI is accelerating the core business rather than disrupting it, with generative AI revenue growing 400% year-over-year. Third, Google Cloud has transformed from a money-losing operation into a high-margin growth engine generating billions in quarterly operating profit. Fourth, valuation is reasonable at 25 times forward earnings versus peers, trading at 30 to 36 times. While the massive $180 billion capex guidance for 2026 is a bitter pill for short-term free cash flow, we view it as a necessary investment to secure Alphabet's dominance in the AI era for the next decade. For long-term investors willing to hold through regulatory noise and the heavy investment cycle, Alphabet remains a foundational technology holding that belongs in every serious growth portfolio. Before we wrap up, a quick but important reminder. This video is for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any security. The stock market involves significant risks, including the potential loss of principal, and you should always conduct your own research or consult with a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. If you found this deep dive into Alphabet helpful, please hit the like button, subscribe to Orange US Stock Research, and turn on notifications so you never miss our upcoming analyses. Let us know in the comments what you think about Alphabet's massive AI investments and whether you believe the capex spending will pay off. Thanks for watching, and we will see you in the next video.